By the end of this video, you'll know exactly why the S&P 500 is the single best investment most people can make and why the data keeps proving it year after year. I'm going to walk you through 3 reasons. And the last one, it's the one Warren Buffett himself has bet his fortune on. So sit back. This one might change how you think about money forever. Here's the thing. Most professional money managers can't beat the market. Not once, not twice, almost never. And I have the numbers to prove it. A study by S&P Global found that over a 15-year period ending in 2023, more than 90% of actively managed funds underperformed the S&P 500. 90%. Let that number sit for a second. These are professionals with teams of analysts, expensive research tools, and decades of experience. And they lost to a computer buying 500 companies and just sitting there. Why? Because the market is incredibly efficient. The moment something is undervalued, thousands of algorithms and investors pile in. The moment something is overvalued, smart money gets out. By the time your fund manager spots the opportunity, it's already priced in. It's like trying to find a $20 bill on a sidewalk in Manhattan. Sometimes it happens, but consistently, almost never. Here's the first reason the S&P 500 works for regular people like you and me. It's diversified by definition. When you buy an S&P 500 index fund, you're buying a tiny slice of 500 of the largest American companies. Apple, Microsoft, Nvidia, Amazon, JP Morgan. You're not betting on one company. You're betting on the entire American economy. And here's the thing about that bet. It has never permanently failed. Not once in the history of the index. The S&P 500 launched in 1957. Since then, it's weathered the 1970s oil crisis, the dot-com crash in 2000, the 2008 financial crisis, the pandemic in 2020. And every single time, it recovered. Every single time, it made new all-time highs. That's not luck. That's what happens when you own a piece of the most productive companies in the world's largest economy. Now, here's the second reason. And this is the one most people completely overlook. Fees. The fees destroy returns. Not dramatically, not overnight, but slowly, quietly, and completely. A typical actively managed mutual fund charges around 1% per year in management fees. Some charge 1.5%, some charge 2%. That doesn't sound like much. I know. But here's what happens. Over 30 years, a 1% annual fee doesn't just eat 1% of your money. It eats roughly 30% of your total returns because fees compound, just like returns do. An S&P 500 index fund from Vanguard or Fidelity costs about 3 to 10 basis points per year. That's 0.03 to 0.1%. You almost don't notice it. My friend Carlos, he's a teacher in Phoenix. He started investing in an S&P 500 fund at 25, just $200 a month. No fancy strategy. No stock picking. By 55, he had over $400,000. The market helped. Time helped. But you know what really helped? Not paying a manager a single extra dime for 30 years. If you're finding this useful so far, hit subscribe. I put out videos like this every week. And the next point is the one that really ties everything together. All right, here's the one I've been saving. Warren Buffett, the Oracle of Omaha, the most successful investor of the modern era. In 2007, he made a famous bet. He wagered $1 million that an S&P 500 index fund would outperform a portfolio of hedge funds over 10 years. He picked the fund. His opponent, a fund manager named Ted Sides, got to pick the hedge funds. The best hedge funds, the ones with the smartest people and the most sophisticated strategies. The result? The S&P 500 returned 125% over that decade. The hedge fund portfolio? 36%. Buffett won by a landslide. And after it was over, he didn't gloat. He didn't gloat much anyway. What he did say was this: when the next generation inherits their wealth, index funds should be the core of their portfolio. That's coming from the man who spent 50 years picking individual stocks and becoming a billionaire. He looked at the evidence. He did the math, and he chose index funds. That one fact changes everything about how you should think about investing. If the greatest stock picker of our generation says most people should just buy the market, maybe we should listen. So here's what it comes down to. The S&P 500 gives you 3 things nothing else can match. Broad diversification across 500 companies. Rock bottom fees that compound in your favor over decades. And the historical proof that it works. Through every crisis, every recession, every reason to panic, it keeps coming back stronger. You don't need to pick stocks. You don't need to time the market. You don't need to pay someone to do it for you. You just need to start, and you need to stay. Look, I get it. It doesn't feel exciting. You open your account and you buy a fund that just holds 500 companies. There's no story there. No thrill of the pick. But you know what's exciting? Checking your balance at 65 and seeing a number that lets you retire with dignity. That's exciting. That's the whole point. If this video made you think differently about your money, share it with someone who's still paying high fees to a fund manager who can't beat the market. Hit subscribe so you don't miss the next one. And if you want to go deeper, I've got a whole series on how to actually build a portfolio starting with nothing. See you in the next one.